Before we get started, it's incredibly important to state that this video is for educational and informational purposes only. I am not a licensed insurance agent or a financial advisor. The world of insurance is complex and specific to your individual situation, your state, and your provider. Think of this as your ultimate guide to asking the right questions, but always consult with a qualified, licensed professional before making any decisions about your policy. You're standing in the driveway. The sun is glinting off the hood of the car. You hold out the keys and your teenager takes them. Their face is a perfect mix of terror and pure unadulterated joy. Your heart is doing a backflip. This is it. A milestone. A massive step towards independence. You feel a surge of pride, followed immediately by a wave of anxiety that's so strong it could power a small city. You've prepared them for this. You've logged the hours, practiced the parallel parking, and lectured them on the dangers of texting and driving until you were blue in the face. They're ready. But are you? A few weeks later, an email hits your inbox. It's from your insurance company. You click it open, expecting a slight increase. And that's when your jaw hits the floor. The number you see is so shockingly high, you're convinced it's a typo. It can't be real. Adding your brand new 16-year-old driver to your policy has just doubled, or maybe even tripled your premium. Welcome to the club. The average cost to add a teenage driver to a parent's car insurance policy in the United States is over $3,000 a year. Let me say that again. $3,000 annually. That's an extra $250 a month. That's a car payment. That's a student loan payment. In some parts of the country, it's a mortgage payment. Feels like a penalty, a punishment for having a kid who wants the freedom that every generation before them has enjoyed. But what if I told you that number, that soul-crushing, budget-busting number, is not set in stone? What if I told you that for most families, it's a worst-case scenario price tag that you absolutely do not have to pay? That is exactly why I made this video. We are going to pull back the curtain on the confusing, frustrating, and outrageously expensive world of teen auto insurance. This isn't about finding a $10 a month discount for going paperless. This is about a fundamental strategy shift. We are going to arm you with the knowledge, the questions, and the secret leverage points that insurance companies don't advertise on their commercials. We're talking about strategies that can slash that premium not by 5 or 10%, but by 30, 40, or in some cases even 50%. By the end of this presentation, you will understand the system better than 99% of parents out there. You'll know the single biggest mistake that costs families thousands. You'll discover the one discount that almost everyone qualifies for but almost no one asks about. And you'll learn how a simple conversation about your teen's report card can be worth more than a brand new laptop. This is the playbook you wish someone had handed you the day your kid got their learner's permit. So let's start with the big question. Why? Why is it so ridiculously expensive? Is it just a giant scam? The answer is no, but it's based on something just as frustrating. Cold, hard statistics. To an insurance company, everything is about risk. That's their entire business model. They take in premiums from everyone, invest that money, and use it to pay out claims for the few who have accidents. To stay profitable, they have to be masters of predicting who is most likely to file a claim. They have actuaries, entire teams of math wizards, whose only job is to calculate the probability of you getting into a wreck. When they look at you, a 40-year-old parent with 25 years of driving experience and a clean record, they see a safe bet. You're predictable. You're statistically very unlikely to cause a major accident. Your risk profile is low, so your premium is manageable. Then they look at your 16-year-old, and what they see terrifies them. They don't see your kid, the one you taught to be responsible. They see a data point, and that data point is screaming danger. The statistics are brutal. Per mile driven, teen drivers are nearly 3 times more likely than drivers aged 20 and over to be in a fatal crash. The number one cause of death for U.S. teens is motor vehicle accidents. They lack experience in judging gaps in traffic, they're more prone to distraction, and their brains are literally not yet fully developed, particularly the prefrontal cortex, which is responsible for impulse control and risk management. So, when your insurance company gives you that $3,000 quote, they aren't trying to punish you. They are, from their perspective, simply pricing in the sky-high statistical risk. They are betting that your teen is far, far more likely to cost them money, potentially tens or even hundreds of thousands of dollars in a claim, than you are. They are essentially making you pay up front for the probability of that future accident. Understanding this mindset is the absolute key to lowering your bill. You can't change the national statistics. You can't magically give your teen 10 years of driving experience, but you can change how the insurance company views your specific teen. Your entire goal is to convince them, using their own rules and their own language, that your kid is not part of that scary statistic. Your job is to prove that your teen is an exception to the rule. You need to present them as a lower risk bet. Every strategy, every discount, every tip we are about to cover is designed to do just that. It's about systematically chipping away at that mountain of perceived risk until your premium comes tumbling down to a much more manageable level. And the very first place to start this process isn't with a phone call or a fancy new car. It begins with a choice. The choice you make about how to insure your teen is the foundation upon which every other saving is built. Get this first step wrong, and you'll be overpaying for years, no matter how many other discounts you find. Get it right, and you've already won half the battle before you even dial your agent's number. There are two primary ways to insure a new teenage driver, and one of them is almost always a catastrophic financial mistake. The first option is to add them to your existing policy. The second is to get them their very own separate policy. On the surface, a separate policy might sound appealing. Feels clean. Separates their risk from your own. If they get in an accident, it's on their policy, not yours, right? Sounds logical. Sounds responsible. And in almost every single case, it is the absolute worst financial decision you can make. Let's break down exactly why this is a trap, and why understanding this one concept is your first major step towards saving thousands. So let's meet the Millers. Totally normal family. 2 parents, a 16-year-old son named Jake, and a golden retriever that sheds on everything. Jake just got his license. He's a good kid, gets decent grades, and after a summer of working at the local movie theater, he's saved up enough to buy his first car with some help from his parents. It's a 10-year-old Honda Civic. Safe, reliable, perfect. They're all standing in the driveway, proud. The keys are in Jake's hand. And then his dad says the 6 words that start the whole expensive mess. Now we need to get you insurance. Jake, being the responsible kid he is, says, I want to pay for it myself. I want my own policy. It'll be my car, my responsibility. And his parents, beaming with pride, think, wow, what a great kid. He's really growing up. So they get on the phone. They call their insurance agent, the same one they've used for 15 years, and say, hi, we'd like to get a quote for our son Jake. He's 16, just got his license, and he has a 2014 Honda Civic. He'd like his own separate policy. There's a pause on the other end of the line, a little bit of typing, and then the agent comes back with a number. And that number is so shockingly high, so astronomically absurd, that the Millers think it must be a typo. They think the agent must have accidentally quoted them a policy for a Lamborghini driven by a professional race car driver in the middle of a war zone. We're talking $400, $500, even $600 a month. For a 10-year-old Honda, that's more than the car payment would be if they bought it brand new. Jake's summer earnings would be gone in 3 months. What just happened? The Millers fell into the responsibility trap. And the reason it's a trap is because it goes against the single most fundamental principle of insurance: the spreading of risk. Think of it like this. An insurance company is like a giant potluck dinner. Everybody brings a dish. Most people, like Jake's parents, have been cooking for years. They bring a big, reliable, predictable casserole. It's safe. It's boring. It's exactly what you expect. They have a 25-year driving record, no accidents, they own a home, they have good credit. They are a known quantity. Their casserole is low risk. Now here comes Jake, a brand new driver. In the eyes of the insurance company, he's not bringing a casserole. He's bringing a mystery box. And statistically speaking, that box is probably filled with fireworks and a lit match. He has 0 years of driving experience. He has no established credit history, which is a huge factor in setting rates. And let's be blunt, his brain is not fully developed. The part that controls impulse control and long-term decision-making, the prefrontal cortex, is still under construction. Insurance companies have mountains of data on this. They know with terrifying accuracy that 16 to 19-year-olds are nearly 3 times more likely to be in a fatal crash per mile driven than drivers aged 20 and over. So when Jake asks for his own policy, he is essentially starting his own, separate potluck dinner. And the only guests are him and a bunch of other teenagers with their own mystery boxes full of fireworks. The insurance company looks at this little party and has a full-blown panic attack. The risk is concentrated. It's off the charts. To cover that risk, they have to charge an insane amount of money. That's why his quote is $500 a month. Now let's rewind. What if the Millers hadn't fallen into the trap? What if, instead of asking for a separate policy, they had asked, "How much would it be to add Jake to our existing policy?" The agent types for a moment, and the new number comes back. "Okay," the agent says, "your policy will go up by $180 a month." $180, not $500. Let that sink in. They are saving over $300 every single month. That's nearly $4,000 a year. Why? Because now Jake isn't at his own terrifying high-risk potluck. He's been brought to his parents' big, boring adult potluck. His little mystery box of fireworks is now sitting on a giant table next to 20 other reliable casseroles, a few sensible green salads, and a dependable Jell-O mold. The overall risk of the entire dinner has gone up. Yes, that's why the parents' premium increases by $180. But the risk has been diluted. It's been spread out. Jake's individual, sky-high risk is now averaged in with his parents' decades of low-risk stability. The insurance company can stomach that. They can price that reasonably. This is the number one rule. Do not let your teen get their own policy. Ever. Not until they are well into their 20s, have moved out, and have established their own independent life. Putting them on your policy leverages your good history, your multi-car discount, your potential home and auto bundle discount, your loyalty discount. All things a 16-year-old has no access to. You are essentially giving them a massive multi-thousand-dollar a year head start by letting them piggyback on your stability. It's one of the single greatest financial gifts you can give your child as they start their driving journey. So problem solved, right? Add the teen to your policy, save a fortune, and everyone's happy. The Millers are relieved. They add Jake to their policy, hand him the keys, and he drives off into the sunset, saving thousands of dollars a year. It seems like the perfect happy ending. But it's not. Because in solving that first very expensive problem, they have just created a second, far more dangerous one. A problem that most families never even think about until it's too late. By adding Jake to their policy, the Millers have now chained their entire financial existence to the bumper of that 10-year-old Honda Civic. They've made a decision that could, with one wrong turn or one glance at a text message, cost them not just a few $1,000s, but their home, their retirement savings, and everything they have ever worked for. The simple act of adding a teen to your policy opens a door to a level of financial risk most people cannot even comprehend. And protecting yourself from that is the most important step of all. So how do you build that fortress? How do you protect yourself? It starts by understanding a secret that the insurance industry doesn't exactly advertise. The policy most people have, the one you probably have right now, is designed to protect the other driver, not you. It's designed to meet the bare minimum legal requirement, and that's it. To truly protect your family, you need to understand 3 little numbers on your policy declaration page. They usually look something like this: 25/50/25, or maybe 50/100/50. They're called your liability limits, and they are the most important and most misunderstood numbers in your entire financial life. Let's make this real. Picture your son or daughter. It's a Friday night. They've had their license for 6 months. They're a good kid, a good student, and a careful driver. They ask to borrow the car to go to the movies with a couple of friends. You hesitate for a second, that little knot of parental anxiety tightening in your stomach, but you say yes. You tell them to be careful, to be home by 11. An hour later, they're driving down a busy road. The sun is setting, creating a glare on the windshield. Their friends are laughing in the back, the radio is on. For a single fleeting second, their phone, which is in the center console for navigation, buzzes with a text from you asking if they got there okay. They glance down, just for a second, but a second is all it takes. When they look up, the brake lights of the minivan in front of them are blazing red. They slam on the brakes, but it's too late. The sound of crunching metal and shattering glass is deafening. Their airbag deploys, filling the car with a chalky smoke. But it's not over. The impact shoves the minivan into the oncoming lane, where it's T-boned by an SUV. The aftermath is a chaotic nightmare. Flashing lights, sirens, paramedics. Your teen is thankfully okay, just shaken up and bruised. But the driver of the minivan, a mother with 2 kids in the back, has a serious back injury. One of the kids has a broken arm. The driver of the SUV, a surgeon on his way to the hospital, has a compound fracture in his leg that will require multiple surgeries and months of rehabilitation. He may never operate with the same precision again. A few weeks later, the letters start to arrive. Not bills, but letters from attorneys. The minivan is totaled. That's a $40,000 loss right there. The SUV is also a total loss, a $70,000 vehicle. The initial medical bills for the mother in the minivan are already over $100,000, and she's going to need ongoing physical therapy. The surgeon's first surgery cost $60,000. His lost income claim because he can't work is projected to be over $500,000. The total damages, when all is said and done, are easily going to exceed $1 million. Now, let's go back to those three little numbers on your insurance policy. Let's say you have what's considered good coverage in many states. 100/300/100. It sounds like a lot of money, right? Let's break down what it actually means in this nightmare scenario. The first number, 100, stands for $100,000. That is the maximum amount your insurance company will pay for bodily injury to any one single person in an accident you cause. The surgeon's medical bills and lost income are over $500,000. Your policy pays the first $100,000, and then it stops. The remaining $400,000 plus? That's on you. The second number, 300, stands for $300,000. That's the maximum amount your insurance company will pay for bodily injury for the entire accident, no matter how many people are hurt. In our scenario, we have the surgeon, the mother, and her child. The surgeon gets his $100,000. That leaves $200,000 for the mother and her child. Their combined medical bills are already well past that. So, your insurance pays out the full $300,000, and then it stops. The rest of the medical costs, the pain and suffering claims, that's on you. The third number, 100, stands for $100,000. That's the maximum amount your insurance company will pay for all property damage you cause. The minivan and the SUV together were worth $110,000. Your policy pays the first $100,000, and that last $10,000? You guessed it. That's on you. So after your good insurance policy has paid its maximum limit, you are now personally, legally, and financially responsible for a bill that could easily be over $700,000. And that's when their lawyers come for everything. They will put a lien on your house. They will garnish your wages for the next 20-30 years. They will seize your retirement accounts, your savings, your kids' college funds. Everything you have ever worked for, and everything you ever will work for, can be taken to satisfy that judgment. All because your teen glanced at a text message for 1 second. This is the catastrophic risk we're talking about. And buying the state minimum coverage of 25/50/25 in this scenario? It's like trying to put out a house fire with a water pistol. It's functionally useless. So what is the answer? The first step is to immediately call your agent and raise your liability limits. Don't ask for full coverage. That's a meaningless marketing term. Ask for specific numbers. You should have, at the absolute minimum, 250/500/100. That's $250,000 per person, $500,000 per accident, and $100,000 for property damage. The cost to go from a state minimum policy to this level of real protection is shockingly small. We're often talking about the price of a few cups of coffee a month. It is the single highest value, lowest cost decision you can make to protect your family's future. But even that might not be enough. As we saw in our story, lawsuits can easily climb into the millions. For that, you need the ultimate defensive weapon in personal finance. It's called a personal liability umbrella policy, and it is your financial fortress. An umbrella policy is a separate insurance policy that sits on top of your auto and homeowner's insurance. It only kicks in when your primary policies have paid out their maximum limit. Think of it like a backup generator for your financial life. So, in our accident scenario, let's say you had that 250/500/100 auto policy. Your insurance pays out its $500,000 limit for the injuries. The remaining lawsuit is still for another $500,000. Instead of their lawyers coming after your house, your umbrella policy kicks in and pays that remaining $500,000. Your assets, your savings, your future are all safe. And here's the most incredible part. A $1 million umbrella policy often costs between $200 and $400 for the entire year. That's less than $1 a day. For $1 million of armor plating around your entire net worth, you can get $2 million, $5 million, even $10 million policies. For any family with a teen driver, an umbrella policy is not a luxury. It is an absolute, non-negotiable necessity. It is the difference between a terrible accident being a manageable insurance claim versus a life-destroying financial event. So right now, your homework is to pull out your insurance declaration page. Find those three little numbers. If they are not at least 250/500/100, you need to call your agent today. And if you don't have an umbrella policy, you need to get a quote today. This is the foundation. This protects you, your house, and your savings from the world. You've just built a fortress around your life savings. But what happens when your teen calls you from the side of the road, their car a twisted wreck? Because the coverage we just talked about won't pay a single penny to fix it. That's right, bodily injury and property damage liability. It's all about paying for the other guy, the person your teen hit, their car, their medical bills, their pain and suffering. It's the shield that protects your house, your retirement, your entire future from being seized in a lawsuit. It's absolutely non-negotiably the most important coverage you can buy. But as you stand there on the phone, listening to the sirens in the background and your kid's shaky voice, a sick feeling creeps into your stomach. The car they were driving, the one you just bought them 6 months ago, is a crumpled mess. The tow truck driver is hooking it up, and your massive $1 million liability policy won't do a thing. It's not designed to. This is where the second major piece of the auto insurance puzzle comes into play. It's what most people call full coverage, but the industry calls it physical damage coverage. And it's broken into two critical parts. The first part is called collision. It's exactly what it sounds like. Collision coverage pays to repair or replace your own car if it's damaged in a collision with another object. That object is usually another car, but it could also be a tree, a guardrail, a telephone pole, or even a particularly sturdy mailbox. If your teen is at fault for the accident, this is the coverage that fixes your car. If the other driver is at fault, their property damage liability should pay for it, but having your own collision coverage can speed up the process immensely, letting your insurance company pay you, and then go after the other driver's company for reimbursement. For a teen driver, who is statistically more likely to be in an at-fault accident, collision coverage is the difference between a massive repair bill and, well, a slightly less massive one. The second part is called comprehensive, or sometimes, other than collision. Think of comprehensive as the coverage for all the weird, random, non-driving chaos life can throw at a car. A tree limb falls on it during a storm. A deer decides to play chicken on a country road and loses. It gets stolen from the movie theater parking lot. It's vandalized. Catches on fire. A hailstorm makes the roof look like a golf ball. All of that's comprehensive. It's for damage that happens when the car isn't in a traditional crash. It's the acts of God and acts of jerks coverage. Together, collision and comprehensive are the armor that protects the physical vehicle itself. But this armor comes at a cost, and you have a huge amount of control over that cost through one simple, and often misunderstood number: your deductible. Think of your deductible as your share of the repair cost. It's the amount of money you have to pay out of your own pocket before the insurance company pays a single dollar. If you have a $1,000 deductible and the repair bill for your teen's car is $5,000, you pay the first $1,000, and the insurance company pays the remaining $4,000. If the repair bill is $900, you pay all $900. The insurance company pays nothing because the cost was less than your deductible. Here is the golden rule of deductibles. A higher deductible means a lower premium. A lower deductible means a higher premium. Think about it from the insurance company's perspective. If you choose a high deductible, say $2,000, you're telling them, "Don't bother me with the small stuff. I can handle the little fender benders and scrapes myself. I only need you for a catastrophic event." This makes you a lower risk to them because they won't be paying out for every little claim. So they reward you with a lower monthly or semi-annual bill. If you choose a low deductible like $250, you're telling them, "I want you to cover almost everything. I can't afford a big unexpected repair bill." This makes you a higher risk to them, so they charge you a higher premium to compensate. For a teen driver, this is a powerful lever. Raising your deductible from $500 to $1,000 can often save you hundreds of dollars per year on your premium. The key is to choose a deductible that you can comfortably afford to pay at a moment's notice. Don't pick a $2,000 deductible if you don't have $2,000 in an emergency fund. That's just setting yourself up for disaster. But this brings us to the single most important question you have to ask when insuring a teen's car. Is collision and comprehensive even worth it? The answer isn't always yes. Insurance companies will only ever pay out up to the actual cash value, or ACV, of your vehicle. ACV is not what you paid for it. It's not what a dealer is selling a similar one for. It's what your specific car, with its specific mileage, condition, and options, was worth the second before the crash. And for the older high-mileage cars we often give to our teens, that number can be surprisingly low. So you have to do the math. Let's say you get your teen a 12-year-old sedan. Its actual cash value is about $4,000. You get an insurance quote, and the portion of the premium for just collision and comprehensive coverage is $100 a month, or $1,200 a year. You've selected a $1,000 deductible to keep that cost down. Now let's play it out. Your teen totals the car. The absolute maximum the insurance company will pay you is the actual cash value, minus your deductible. So, for $1,000 minus your $1,000 deductible, the check you get is for $3,000. But wait, you've already paid $1,200 that year just for the privilege of having that coverage. So, your net gain from the insurance is only $1,800. You spent $1,200 to protect yourself from a $3,000 loss. Is that a good bet? For some, yes. For others, maybe not. What if the car isn't totaled? What if the damage is only $1,500? You pay your $1,000 deductible, the insurance pays $500. You just spent $1,200 in premiums for a $500 payout. That's a terrible deal. A good rule of thumb is this. If the annual cost of your collision and comprehensive coverage is more than 10% of your vehicle's actual cash value, you should seriously consider dropping it. You could take that $1,200 you're saving on premiums and put it in a separate savings account. In a couple of years, you'll have enough saved up to replace that old car yourself, no insurance company needed. Now, there's a massive exception to this rule. If you have a loan on the car, the bank or finance company will almost certainly require you to carry collision and comprehensive coverage with a low deductible. You have no choice. The car is their asset until you pay it off. And this creates another terrifying trap, especially with newer cars, being upside down. This is when you owe more on your loan than the car is actually worth. Cars depreciate the second you drive them off the lot. So let's say you owe $25,000 on a car that now only has an actual cash value of $20,000. Your teen totals it. The insurance company writes you a check for $20,000, minus your deductible. You still owe the bank another $5,000. For a car that is now a pile of scrap metal, you're making payments on a ghost. This is where a special and often cheap add-on comes to the rescue: gap insurance. Gap insurance covers the gap between what your car is worth and what you still owe on it. In that scenario, gap coverage would have paid that extra $5,000 to the bank, saving you from a financial nightmare. If you are financing a car for your teen, you absolutely must ask about gap insurance. So let's recap. We've built the fortress of liability to protect your life savings from the outside world. And now we've added the armor of collision and comprehensive to protect the car itself, carefully choosing a deductible you can afford and making a calculated decision about whether the coverage is even worth the cost. We've even covered the gap for a financed car. The vehicle is protected. Your assets are protected. But what about the most precious thing of all? What about the people inside your car? What happens when your own child is injured in an accident and the medical bills start rolling in? Because the coverages we've just discussed, they won't pay for that either. That's a terrifying thought, isn't it? You do everything right. You buy a safe car, you teach your kid to be a defensive driver, you get the insurance the law requires, and yet, there's a massive gaping hole in your protection. A hole that your own family could fall into. The reality is, if your teen is in an accident they caused, and they or their friends in the car get hurt, the standard liability and physical damage coverages we just talked about will not pay one single dollar toward their medical bills. Not for the ambulance ride. Not for the emergency room visit. Not for the stitches, the x-rays, or the physical therapy. Nothing. This is where two of the most misunderstood and frankly most important coverages on your entire policy come into play. They are the guardian angels for the people inside your vehicle. They are medical payments coverage, often called MedPay, and personal injury protection, or PIP. And understanding the difference between them and why you absolutely need one of them is non-negotiable. Let's start with medical payments coverage, or MedPay. Think of MedPay as a first aid kit for your finances. It's designed to do one thing and one thing only: pay for reasonable and necessary medical and funeral expenses for you and the passengers in your car after an accident, regardless of who was at fault. Let that sink in for a second. Regardless of fault. This is huge. Let's say your teen is pulling out of a parking spot and misjudges the distance, lightly tapping another car. It's a low-speed impact, but they get jostled and hit their head on the window. They say they feel fine, but you're a parent, so you're not taking any chances. You take them to the urgent care clinic to get checked for a concussion. The bill comes out to $900. Who pays? If you have MedPay, it does. Your teen was at fault, but it doesn't matter. You file the claim, and the bill gets paid quickly and with no deductible. MedPay covers you, your family members, and any other passengers in your car at the time of the accident. It even covers you and your family if you're pedestrians and get hit by a car, or if you're a passenger in someone else's car. It's a fast, flexible layer of protection. Now you might be thinking, hold on, I have great health insurance. Why would I need to pay for extra medical coverage on my auto policy? Isn't that redundant? This is the single biggest mistake people make. They see the word medical and assume their health insurance has them covered. But MedPay is designed to fill the exact gaps your health insurance leaves behind. First, your health insurance has a deductible. For many families, that's thousands of dollars. A $5,000 ER bill might mean you're on the hook for your entire $3,000 deductible out of pocket. But if you had $5,000 of MedPay coverage, it could pay that entire bill, and you wouldn't pay a dime. It can literally pay your health insurance deductible for you. Second, health insurance has co-pays and co-insurance. It might only cover 80% of the costs after the deductible, leaving you with a huge bill. MedPay can be used to cover those remaining costs. And third, what about the other people in the car? What if your teen is driving their friends to a football game? If there's an accident, are you 100% certain their friends' families have good health insurance? Or any health insurance at all? If they don't, who do you think they'll be looking to for payment of those medical bills? You. Having MedPay protects not just your family, but your relationships and your financial liability to your passengers. It's an incredibly inexpensive way to ensure everyone in your car gets the immediate care they need without a financial battle later. Now let's talk about MedPay's bigger, more powerful sibling, personal injury protection, or PIP. If MedPay is a first aid kit, PIP is a full-blown trauma center. Like MedPay, PIP covers medical expenses regardless of who is at fault. But it doesn't stop there. Depending on your state, PIP can also cover things that MedPay won't, like lost wages. Imagine your 17-year-old has a part-time job to save for college. They're in an accident, break their leg, and can't work for 2 months. PIP can help reimburse them for the income they lost. It can also cover essential services. Let's say you, the parent, were a passenger in the car when your teen was driving, and you were the one injured. You can't cook, clean, or take care of your younger children for a few weeks. PIP can help pay for services like house cleaning or childcare while you recover. It's designed to help you maintain your life, not just patch up your body. In some states, known as no-fault states, carrying PIP coverage is actually mandatory. In these states, your own PIP coverage is your first line of defense for injuries, regardless of who caused the accident. This system is designed to speed up payments and keep smaller injury claims out of the court system. So first, you need to find out if you live in a no-fault state. If you do, you don't have a choice, you'll be buying PIP. But if you live in a state where it's optional, the decision between MedPay and PIP comes down to the level of protection you want. MedPay is a fantastic, affordable option focused purely on medical bills. PIP is a more comprehensive safety net that protects your health, your income, and your household stability. So, how much do you need? Coverage limits for MedPay are typically lower, often starting at $1,000 and going up to $10,000 or even $25,000. PIP limits are generally higher, often starting at $10,000 and going up from there. The best advice I can give you is this. At a bare minimum, you should carry enough MedPay or PIP to cover your family's health insurance deductible. If your deductible is $5,000, you should have at least $5,000 in MedPay. This single step can prevent a car accident from turning into a devastating, out-of-pocket financial crisis. And the cost? This is the best part. For all the incredible protection it offers, MedPay is one of the cheapest coverages you can buy. Adding $5,000 or $10,000 of coverage might only increase your premium by a few dollars a month. We're talking about the price of a single latte to ensure your child's medical bills are paid after an accident. When you weigh that small cost against a potential $5,000 emergency room bill, the value is undeniable. So let's recap the fortress of protection we've built so far. We have liability coverage to protect your assets from lawsuits if your teen is at fault. We have collision and comprehensive to repair or replace your car, no matter what happens to it. And now we have MedPay or PIP to pay the medical bills for your teen, your family, and their friends regardless of who is at fault. You've covered the other guy. You've covered your car. And you've covered your people. Feels like you've finally plugged all the holes. The protective bubble is complete. But there's one more phantom menace lurking on the roads. A threat that even the best teenage driver can't avoid. It's the driver who makes a reckless mistake, barrels through a red light, and T-bones your child in an intersection. The police report is clear. The other driver is 100% at fault. Your problem should be over. Their insurance should pay for everything. But what happens when the police officer comes back and tells you the other driver has no insurance at all? Or they have the absolute bare minimum coverage required by law, which can't even begin to cover the cost of your totaled car and your family's injuries? What happens when they smash into your new driver and simply speed away? A ghost disappearing into traffic. Who pays you then? The answer is you do. You pay for everything. Out of pocket. Every dollar for the hospital bills, the surgeries, the physical therapy. Every penny to replace that crumpled wreck of a car that you just finished making payments on. Your savings, your retirement, your kids' college fund. It all goes up in smoke. Unless you have the one piece of armor that protects you from ghosts. It's called uninsured and underinsured motorist coverage. Let's call it UM/UIM for short. And I'm telling you right now, this is not optional. This is the single most important coverage you can have on your policy, especially with a new teen driver. Think of it as your own insurance company stepping in to play the role of the at-fault driver's insurance when they either don't have any, or they flee the scene. Your insurance company sues itself on your behalf, and then pays you the settlement. It's a strange concept, but it's your financial life raft. This coverage is split into two critical parts. First, there's uninsured motorist bodily injury. If that hit-and-run driver leaves your family with $100,000 in medical bills, this is the part of your policy that pays for it. It covers hospital stays, lost wages if you or your spouse can't work while caring for your injured teen, and even pain and suffering. Without it, you're on your own. The second part is uninsured motorist property damage. This is what buys you a new car. That ghost driver totaled your vehicle and vanished? This coverage steps in and pays to repair or replace it. Now, here's a pro tip. In some states, this part of the coverage has a deductible, and sometimes it's waived if you can identify the driver who hit you, which is impossible in a hit and run. It's a cruel irony. That's why you absolutely need a dashcam, but we'll get to that later. Now let's talk about the silent partner here. Underinsured motorist coverage. This is just as dangerous but far more common. This is for when you're hit by someone who does have insurance, but they only have the state minimum garbage policy we talked about earlier. Let's say your state's minimum for property damage is $10,000. The driver who runs a red light and plows into your teen's brand new $40,000 SUV has that minimum policy. Their insurance company will write you a check for $10,000, wish you the best of luck, and wash their hands of the situation. You are now $30,000 in the hole. But if you have underinsured motorist coverage, your policy pays that $30,000 difference. Fills the gap. The same goes for bodily injury. They have a $25,000 limit, but your family's medical bills are $200,000? Their insurance pays $25,000, and your underinsured motorist coverage can cover the remaining $175,000. It is your shield against the millions of irresponsible drivers on the road. Do not, under any circumstances, skip this coverage. Max it out to match your own liability limits. Okay, so we've protected ourselves from the other guy. But what about the immediate aftermath? In a serious accident, ambulances don't wait for the police to assign fault. Hospitals don't pause treatment while insurance companies argue. The bills start coming immediately. And your health insurance? It might have a $5,000 or $10,000 deductible plus copays. That's where the next non-negotiable coverage comes in. Personal injury protection, or PIP. In some states, it's called medical payments coverage or MedPay. They're slightly different but serve a similar purpose. Think of PIP as a pot of emergency medical cash that's available instantly, regardless of who was at fault. Your teen gets in an accident, your PIP coverage immediately starts paying for the ambulance, the emergency room, the x-rays, right up to its limit. There's no deductible. There's no waiting. It's first in line, no questions asked coverage. This is unbelievably important. It means your family can get the care they need, right now, without you having to drain your bank account, while the insurance companies spend the next 6 months investigating the crash. And here's a massive benefit most people overlook. It covers not just your teen driver, but everyone in their car. If your son or daughter is driving their friends to the movies and gets in a wreck, your PIP coverage can help pay for their friends' medical bills too. Imagine the peace of mind that gives you. It can even cover things like lost wages and other related expenses if you have to take time off work. MedPay is a bit more limited, usually just covering medical bills, but the principle is the same: immediate money for medical care. If your state offers it, get it. Get a high limit. $10,000 or $25,000 in PIP coverage costs very little, but it can be an absolute lifesaver. So now we've covered injuries from other people and we've covered our own immediate medical needs. But we still haven't talked about the most likely scenario of all, the one that keeps parents up at night. It's not the dramatic hit and run. It's the simple, dumb teenage mistake. Your kid is backing out of a parking spot and misjudges the distance to a concrete pole. Your daughter takes a turn too fast on a wet road and slides into a guardrail. Your son is trying to change the music on his phone and drifts into a curb, wrecking a wheel and the suspension. In all of these cases, your teen is at fault. The liability insurance we discussed does nothing. The uninsured motorist coverage does nothing. Who pays to fix your car? This is where the final two pieces of the puzzle come in, and for any car with a loan or any real value, they are absolutely mandatory. They are collision and comprehensive coverage. Let's start with collision. The name says it all. This covers damage to your car when it is involved in a collision with an object or another vehicle, and it's your fault. Hitting that light pole, backing into the garage door, the guardrail incident, all of that is covered by collision. You choose a deductible, say $500 or $1,000, and you pay that amount out of pocket. The insurance company pays for the rest of the repairs, even if it's tens of thousands of dollars. If the car is declared a total loss, they will pay you its actual cash value, minus your deductible. Without collision coverage, if your teen makes one of these common mistakes and totals the car, you get nothing. Zero. The car is gone, and if you have a loan, you're still making payments on a pile of scrap metal. Then there's its partner, comprehensive coverage. This is often called other than collision coverage. It's for almost everything else that could possibly happen to your car. A tree branch falls on it during a storm. A deer jumps out in front of it on a country road. It gets caught in a hailstorm that leaves it looking like a golf ball. Vandals smash the windows. Or the worst-case scenario, it gets stolen and is never seen again. All of these disasters are covered by comprehensive. Just like collision, you pick a deductible, you pay that amount, and insurance covers the rest. Think of it this way: collision is for when your car hits something. Comprehensive is for when something hits your car. Together, collision and comprehensive are often called full coverage. If you have a loan or a lease on your teen's car, the bank will require you to have both. They want to protect their investment. But even if you own the car outright, if you can't afford to just go out and buy a new one tomorrow with cash, you need full coverage. For a new driver, the odds of a fender bender, a scraped bumper, or a more serious at-fault accident are incredibly high. Not having collision and comprehensive coverage on a car for a teenage driver is like walking a tightrope without a net. It's not a matter of if they'll make a mistake, but when. And your job is to make sure that when it happens, it's a learning experience, not a financial catastrophe that derails your family's future. So let's talk about a family. We'll call them the Hendersons. They did everything right. They had the talks, set the rules, and their son, 17-year-old Mark, was a good kid. Honor roll, captain of the soccer team, responsible. They added him to their policy, saw the high premium and winced. Their agent, trying to be helpful, showed them how to get the costs down. You can lower your liability limits to the state minimum, he said. It'll save you about $40 a month. $40 a month. That's a streaming subscription, a few fancy coffees. Seemed like a smart move. They were a safe family after all. Mark was a safe driver. What could possibly go wrong? What went wrong was a Tuesday afternoon in November. Drizzly gray, the roads were slick. Mark was driving home from practice, maybe a little tired, maybe a little distracted by the song on the radio. He was following a late-model Lexus at a safe distance, but the driver slammed on their brakes unexpectedly for a squirrel. Mark reacted a split second too late. The crunch of metal wasn't loud, but it was sickening. A classic fender bender. No one seemed hurt. The other driver, a woman in her 40s, was more annoyed than anything. They exchanged information, Mark apologized profusely, and they both drove away. The Hendersons breathed a sigh of relief. A dented bumper, that's all. Their insurance would handle it. But then the letters started to arrive. First, the estimate from the Lexus dealership. The bumper alone was $2,000. But behind the bumper were proximity sensors, a backup camera, and a wiring harness that were all damaged. The total repair bill wasn't $2,000. It was $9,500. Their state minimum property damage liability was $10,000. They were sweating, but they were covered. Barely. Then the second letter arrived. It was from a law firm. The woman in the Lexus was now claiming a severe neck and back injury. Whiplash. She couldn't work her job as a dental hygienist. She needed physical therapy, chiropractic adjustments, pain medication. The letter detailed projected medical bills, lost wages, and a little line item called pain and suffering. The initial demand? $75,000. The Hendersons looked at their insurance policy. Their bodily injury liability limit was $25,000 per person, the state minimum. Their insurance company would pay the first $25,000, and after that, the Hendersons were on their own. The lawyers for the other driver weren't going after Mark, a 17-year-old with a part-time job. They were going after his parents, their savings account, the equity in their home, their retirement funds. That $40 a month they saved suddenly felt like the most expensive mistake of their lives. This story isn't a scare tactic. It is the reality of the American legal and medical system. A minor accident can spiral into a six-figure lawsuit faster than you can blink. And the state-mandated minimum insurance levels are a joke. They are a financial trap, set for unsuspecting families who think minimum means adequate. It does not. It means the absolute least you can legally have before the state revokes your license. It is not designed to protect you. It is designed to provide a token amount of protection for the person you hit. So what do? You build a fortress. You don't just buy insurance. You buy protection. You buy peace of mind. And that starts with understanding what you're actually buying. Forget the jargon for a second. Let's break it down into plain English. First, liability coverage. This is the big one. This is what protects you when your teen causes an accident. It has two parts: bodily injury, which pays for the other person's medical bills, and property damage, which pays to fix their car or property. You'll see it written as three numbers like 25/50/10. That would mean $25,000 for one person's injuries, $50,000 total for all injuries in an accident, and $10,000 for property damage. As we saw with the Hendersons, this is catastrophically low. So what's the right number? There is no single right answer, but a gold standard, a fantastic starting point for a family with a teen driver, is 100/300/100. That's $100,000 for a single person's injuries, $300,000 total for injuries, and $100,000 for property damage. Think about it. $100,000 for property damage covers totaling most cars on the road today, even luxury ones with all their expensive tech. $300,000 for injuries might sound like a lot, but a single multi-day hospital stay with surgery can eclipse that in a heartbeat. The difference in premium between the pathetic state minimum and this level of robust protection is often less than you think. It is the single most important investment you can make on your auto policy. Going lower is like choosing a cardboard shield in a sword fight. Next up, uninsured and underinsured motorist coverage. This one is crucial. This protects you and your family if you're hit by someone who either has no insurance at all, or who has those joke state minimum policies we just talked about. If your kid is T-boned by someone who runs a red light and that person only has $25,000 in liability, but your kid's medical bills are $80,000, where does the rest come from? It comes from your underinsured motorist coverage. It steps in and acts like the insurance the other guy should have had. You should always match this limit to your own liability limit. If you have 100/300 in liability, you get 100/300 in uninsured motorist coverage. It's protecting your own family from the irresponsibility of others. Then you have collision and comprehensive. People mix these up all the time, but it's simple. Collision covers damage to your car when your teen hits something, another car, a pole, a guardrail. It's the oops, I crashed coverage. Comprehensive covers damage to your car from almost everything else: theft, vandalism, a tree falling on it, hitting a deer, hail, fire. It's the act of God and bad luck coverage. Do you need them? The answer is, how much is the car worth? If your teen is driving a 15-year-old $2,000 beater, and you have a $500 or $1,000 deductible, it might not be worth paying the premium for collision and comprehensive. You could just save that money and be prepared to buy another beater if it gets wrecked. But if the car is anything you can't afford to just walk away from and replace with cash tomorrow, if it's worth $5,000, $10,000, $20,000, then yes, you absolutely need both. Forgoing this coverage on a valuable car is not saving money. It's gambling. And the house always wins. Finally, you might see medical payments or MedPay and personal injury protection or PIP. These are slightly different depending on your state, but they essentially cover initial medical expenses for you and your passengers, regardless of who is at fault. It's fast, immediate coverage to get the bills paid without waiting for a lengthy fault determination. It's relatively inexpensive and can be a lifesaver, preventing you from having to pay out of pocket for an emergency room visit, while the insurance companies sort everything out. So you build your fortress. You start with high liability limits. 100/300/100 is your foundation. You add matching uninsured motorist coverage to guard the gates. You put collision and comprehensive on the watchtower if the car has value. And you add a little MedPay as your first line of defense. This isn't about being paranoid. It's about being prepared. It's about understanding that for a few dollars more, you are buying a shield that can deflect a blow that would otherwise shatter your family's financial future. You're turning a potential catastrophe into a manageable inconvenience. But getting the right coverage is only half the battle. Because even with the perfect policy, the fortress is only as strong as the company that built it. What happens when you actually need to use it? Will they be there with reinforcements? Or will they lock the gates and leave you to fend for yourself? Choosing the right insurance company is just as critical as choosing the right coverage, and many parents make a devastating mistake by focusing only on the price tag. That lowest price tag often hides a terrible secret, a cost you only discover in the frantic, adrenaline-fueled moments after a crash. Imagine this. It's 10 p.m. on a rainy Tuesday. Your teen who just got their license 3 months ago calls you. Their voice is shaking. Mom? Dad? I had an accident. Your heart plummets. You race to the scene and thank God everyone is okay. A little shaken up, a fender bender but safe. That's all that matters. After the police leave and you get your kid home, the second wave of stress hits. The insurance claim. You pull up the policy for CheapoSure, the online company that gave you that unbelievably low quote. You open their app to file a claim. The glitches. You try the website. It directs you to a chatbot. The chatbot gives you a generic FAQ page. Finally, you find an 800 number. You spend 45 minutes navigating a soulless, automated phone tree, only to be connected to a call center representative in a different time zone who asks for a policy number you can't find in the dark. They sound bored, distracted. They tell you an adjuster will call you back in 3 to 5 business days. 3 to 5 business days. Your teen's car is undrivable, sitting in a tow yard racking up storage fees. You need a rental car to get them to school. You need answers. But all you have is a vague promise and the hold music still ringing in your ears. This is the hidden cost of the lowest bidder. Now let's rewind. Same rainy Tuesday, same fender bender, same terrified call from your kid. But this time you're insured with a different type of company. One that costs maybe $20 more a month. Instead of an app, you call a number you have saved in your phone under Our Insurance Agent. A real person answers. It's Mark, the agent you sat down with 6 months ago. He knows your name. He asks if your teen is okay. He sounds genuinely concerned. He says, "Don't worry about a thing. I'm opening the claim right now. I've already got a tow truck dispatched to that location and it's covered. I'm arranging a rental car for you to pick up first thing in the morning. An adjuster will call you tomorrow before noon to walk you through the next steps. Just focus on your family tonight. We'll handle the rest." Which of those two scenarios are you willing to pay for? The difference isn't just a few dollars. It's the difference between chaos and confidence, between being a number in a spreadsheet and a person in a crisis. The single most important factor when choosing an insurer for your teen isn't the price. It's their claim satisfaction record. This isn't just a fluffy metric. It's a hard data measurement of how a company performs when their clients are at their most vulnerable. Organizations like J.D. Power and Consumer Reports publish these ratings annually. They survey thousands of real customers about their real experiences. They ask, how easy was it to report the claim? How fair was the settlement? How quickly was it resolved? How was the communication? Ignoring these ratings is like hiring a bodyguard based on who has the cheapest suit, without ever asking if they know how to fight. You need to go online right now and look up the most recent J.D. Power Auto Claim Satisfaction Study. Look up your state's Department of Insurance website, which often tracks consumer complaints against carriers. You will see a pattern. You'll find that some of the companies with the catchiest commercials and the lowest advertised rates consistently rank at the bottom of the list for actually paying claims and taking care of their customers. Their business model, in some cases, is built on collecting premiums and then making the claims process so difficult, so frustrating, that a certain percentage of people simply give up. They are betting on your exhaustion. Don't let them win. Beyond the nightmare of a bad claims process, there's the second battleground: ongoing customer service. Let's be honest, insuring a teen driver is not a set-it-and-forget-it transaction. Questions will come up. You'll want to know if their good grades have been applied to the discount. You'll need to add or remove a vehicle when they go to college. You might need to adjust coverage levels as their driving experience grows. With a massive, faceless online insurer, every single one of these interactions is a roll of the dice. You'll likely speak to a different person every time you call. Someone who has to pull up your file and get up to speed on your family's history from scratch. You are starting from zero with every single phone call. Contrast that with having a dedicated agent, or at least a dedicated local office. This is a person or a team that knows you. They remember the conversation you had about your son starting his first job or your daughter looking at colleges out of state. When you call with a question, you're not just policy number 7-4 Bravo Tango. You're the Johnson family. That relationship has tangible value. That agent is motivated to keep your business, so they are your advocate within the larger company. They can help you navigate billing issues, find obscure discounts, and give you proactive advice. When your teen gets a speeding ticket, and let's be realistic, it might happen, who would you rather call for advice? An anonymous call center employee reading from a script, or Mark, your agent, who can tell you exactly how it will impact your rates and what steps you can take, like a defensive driving course, to mitigate the damage? This leads us to the third and final battleground in choosing a provider: the clash between the digital experience and the human touch. In our modern world, we're conditioned to want a slick app for everything. And yes, a good app that allows you to view your policy, pay your bill, and access your insurance cards is a fantastic convenience. Many top-tier companies offer this. But do not let a flashy user interface trick you into believing it's a substitute for competent human support. The app is great for the 99% of the time when things are normal, but your insurance policy exists for the 1% of the time when things go terribly wrong. And in that moment, the app can become a digital ghost in the machine. What happens when you're on the side of the road, your phone screen is cracked, and the app won't load your proof of insurance? What happens when you need to understand a complex coverage question that isn't addressed in the app's FAQ? The best-case scenario is a hybrid model. A company that offers the convenience of modern technology, backed by the reliability of accessible, knowledgeable human beings. Before you sign on the dotted line, test them. Call their customer service line at an off-peak hour. See how long it takes to get a person on the phone. Ask them a tricky hypothetical question about coverage for a teen driver using a friend's car. Is the answer clear, confident, and helpful, or do they sound like they're just trying to get you off the phone? Choosing an insurance company for your teen is not a simple price comparison. It's a job interview. You are hiring a company to be your family's financial first responder. You need to vet them. Check their public complaint records. Read their claim satisfaction scores. Call them and test their service. Because when your kid makes that dreaded phone call, you won't be thinking about the $20 a month you saved. You'll only be thinking about who is going to answer your call for help. Now that you know how to identify the right kind of company, how do you actually get them to offer you their best possible price? There's a specific strategy and negotiation tactic that most people never use that can save you hundreds, even thousands, without sacrificing a single ounce of quality. It's a method I call the independent agent gauntlet. And no, it has nothing to do with yelling at a poor customer service rep or trying to haggle like you're at a flea market. This is a sophisticated, respectful, and devastatingly effective strategy that puts the power back in your hands. It forces insurance companies to compete for your business in a way they never do when you just fill out a form on their website. First, let's talk about how 99% of people shop for insurance. They go online. They get a quote from Progressive. They get a quote from GEICO. Maybe they call their local State Farm agent who their parents have used for 30 years. They look at the three prices, maybe they tweak a deductible, and they pick the cheapest one. This is, without a doubt, the absolute worst way to do it. When you do this, you are playing a game that is rigged against you. You are a single customer approaching a multi-billion-dollar corporation on their terms, through their website, using their algorithm. They have all the information, all the data, and all the power. You are just a number. They give you a price, and your only option is to take it or leave it. The independent agent gauntlet flips the entire script. It changes the power dynamic completely. So what is it? It starts with understanding the two types of insurance agents. First, you have what's called a captive agent. This is someone who works for one and only one company. Your State Farm agent is a captive agent. Your Farmer's agent is a captive agent. They can be great people, but their toolbox is limited. They can only sell you State Farm or Farmers products. If that company's rates are high for teen drivers, they can't do anything about it. Their only solution is a State Farm solution. But then there's the independent agent. An independent agent is a broker. They don't work for an insurance company. They work for you. They have contracts with dozens of different insurance companies, sometimes 50 or more. These include the big names you know, but more importantly, they include incredible regional and specialty carriers you've never even heard of. Companies like Erie Insurance, Auto Owners, The Hartford, Safeco, or Mutual of Enumclaw. These are powerhouse companies that often have much better rates and customer service than the giants who spend billions on TV commercials, but they don't sell directly to the public. They only work through independent agents. The independent agent is your secret weapon. Their job is to take your specific situation, a family with a new teen driver, and shop it across their entire network of companies to find the absolute best fit for you, at the best price. You are not a number to them. You are a client they want to win and keep. So here is the gauntlet strategy step by step. Step 1, you are going to find 3. Not 1, not 2. 3 top-rated independent insurance agents in your state. Go to Google and search for Independent Auto Insurance Agent near me. Ignore the ads. Look at the Google business profiles. You are looking for agents with a high number of positive, detailed reviews. People who say things like, "Sarah saved me $800 and got me better coverage." Not just "they were nice." You need 3 because even independent agents can have different company appointments or their own personal biases. By using 3, you create a layer of competition among the experts themselves. Step 2. You prepare your dossier. Before you pick up the phone, you get organized. This is critical. It signals to the agent that you are a serious, prepared client, and they will work harder for you. In a folder, you will gather the driver's license numbers and dates of birth for every driver in the house, the vehicle identification numbers, or VINs, for every car, a copy of your current insurance policy's declarations page. This is the summary of your current coverage and price, your teen's most recent report card to prove their GPA for the Good Student discount, their driver's ed completion certificate, and finally, your desired coverage levels. Don't be vague. Based on what we talked about in the last part, know exactly what you want. For example, I want 100/300/100 liability, uninsured motorist stacked, with $500 deductibles for collision and comprehensive. Step 3, you make the first call. You call agent number 1. You will be polite, professional, and you will use this exact script. "Hi, my name is," your name. "I'm currently shopping for my family's auto insurance policy, which includes a new teenage driver. I'm speaking with a couple of different agencies to find the best possible combination of coverage and value. I have all of our information compiled and ready to go. Would it be best if I emailed it to you so you can shop it with all of your carriers and come back to me with your most competitive quote?" Let's break down why this script is magic. It immediately establishes that you are a serious, organized buyer. It tells them respectfully that they have competition, and it sets the expectation that you want their best foot forward from the very beginning. You're not there to waste time. Step 4, repeat. You make the exact same call to agent number 2 and agent number 3. You email them the same, perfectly prepared dossier of your information. Now take a deep breath. You have just unleashed 3 separate insurance experts who are now simultaneously working on your behalf, combing through dozens of insurance companies to earn your business. Your work is basically done. Theirs is just beginning. Step 5, the leverage round. Within a day or 2, the quotes will start rolling in. This is where the magic really happens. Let's say agent 1 comes back with a great quote from a company called Travelers for $4,200 a year. Agent 2 comes back with a quote from Progressive for $4,500. And agent 3 hits a home run. They found a policy with a regional carrier, let's call them Badger Mutual, for $3,400 a year for the exact same coverage. Do you just take the Badger Mutual quote and run? No. This is the gauntlet. You now have leverage. You call agent 1 back. You say, "Hi, Sarah. Thank you so much for putting together that quote from Travelers. I really appreciate you running the numbers for me. I do want to let you know that I have received another binding quote that is substantially better on price for the identical coverage. I really enjoyed our conversation and I prefer to give you the business if you can get close. Is there any chance you could reshop it? Or see if Travelers has any other discounts we might have missed?" You are being incredibly polite, professional, and honest. You're not demanding anything. You're inviting them to compete. What happens next is amazing. That agent who wants to earn your commission might say, "You know what? Let me check with my underwriter at Travelers," or "Let me run this through one other carrier I didn't try." They can sometimes be aggressive with teen drivers. 9 times out of 10, they will find a way to sweeten the deal. You do the same with Agent 2. You give everyone a final chance to earn your business. I used this exact strategy for my cousin when his daughter, Chloe, got her license. His renewal with his big national, Good Hands company was going to be an eye-watering $6,000 a year. He was just going to pay it because he didn't know what else to do. We ran the gauntlet. The first round of quotes came in around the $4,500 mark. A big savings, but we weren't done. We took the best quote and went back to the other 2 agents. One of them came back and said, "Okay, I sharpened my pencil. I was able to get it with Safeco with a couple of extra discounts for $3,800. That's a savings of $2,200 a year. That's a family vacation. That's a huge chunk of a college fund, all for about 90 minutes of focused work." This works because you are transforming the market. You're not a lone consumer begging for a good price. You are the prize. You have created a micro-market where 3 professional agencies are competing for you. They have access you don't, they have expertise you don't, and now you've given them the motivation to use all of it to your advantage. After the final offers are in, you make your choice. And it's not just about the absolute bottom dollar price. One agent might be a few bucks more, but if they were faster, more thorough, and explain things better, that's who you should go with. You're not just buying a policy. You're hiring a professional advisor who you can call when you have a question or, God forbid, a claim. So now you've found the right type of company. You've used a professional strategy to guarantee you're getting their best possible price. The policy is locked in. But we are not done. The savings don't stop the day you sign up. There is one final critical piece of this puzzle that almost everyone overlooks. It's a set of habits and tools that can continuously chip away at that premium, year after year, slashing your bill by another 10, 20, even 30% over time. It's the secret weapon for long-term savings, and it's the last thing we need to cover. This isn't about finding a single hidden discount. It's about building a system of proactive management that turns you from a price taker into a price maker. Let's call it the active savings cycle, and it has 3 core components that you'll use every single year to guarantee you're paying the absolute minimum. The first and most important component is the annual insurance audit. Mark your calendar right now. Pick a day 1 month before your policy is set to renew, and label it Insurance Shopping Day. Treat it like a birthday or an anniversary. It is non-negotiable. Why? Because insurance companies make a fortune on complacency. They send you that renewal notice, maybe with a small, innocent-looking 5% increase, and they are banking on the fact that you're too busy to do anything about it. They count on you to just sigh, pay the bill, and move on. That's how a good rate slowly becomes a terrible one. Your annual audit shatters that model. On this day, you do 2 things. First, you reshop your policy. You take your exact current coverage, the same liability limits, the same deductibles, everything, and you get quotes from at least 3 to 5 other major insurance carriers. Go to their websites, use a comparison tool, or call an independent insurance agent who can shop for you. You need a clear apples-to-apples comparison of what the market is willing to offer for your business. Once you have those quotes in hand, you make the second and most powerful move. You call your current insurance company. You don't start by yelling or threatening to cancel. You start with a simple, powerful script. It sounds like this. "Hi, my name is," your name, "and my policy number is," your policy number. "My renewal is coming up, and as part of my annual financial review, I've been getting some other quotes. I've been a loyal customer for 5 years, and I'd really prefer to stay with you, but I have a quote here from Progressive for $300 less for the exact same coverage. Is there anything you can do to match that or get closer to it?" You have to understand what this does. You've just transformed the conversation. You're no longer a passive customer accepting a price. You are a valued client with documented, competing offers. The customer service representative will often put you on hold and go speak to what's called the retention department. These are the people whose entire job is to keep you from leaving. They have access to discounts that aren't advertised on the website, loyalty discounts, discretionary discounts, retention credits. You will be shocked at how often they can magically find a way to lower your premium, sometimes even beating the competing offer. If they can't, and the other offer is legitimate, you now have the data and the confidence to switch, knowing you're making the best possible financial decision. Performing this 1-hour audit every year can save you hundreds, if not thousands of dollars over the life of your team's driving years. The second component of the active savings cycle is the technology leverage. We talked about Telematics, the little plug-in device or smartphone app that tracks driving habits. Most people think of this as a one-time discount when you sign up. That is a massive mistake. The data collected by that device is a living record of your teen's improving driving skills. After 6 months or a year of your teen driving with that telematics program, you have a powerful new piece of evidence. They've proven they're not the risky statistic the insurance company initially charged you for. They've demonstrated they are a safe driver through thousands of miles of real-world data. So you call your insurer. You say, "Hi, my teen has been on the Drive Safe program for a full year now and has consistently scored in the top tier for safety. I'd like to request a reevaluation of our premium based on this proven track record of safe driving." You're not just asking for a discount. You're presenting evidence that the fundamental risk profile of the driver has changed for the better. This is a much more compelling argument. Furthermore, as technology evolves, so do the opportunities. Ask your insurer if they offer discounts for dash cams. A growing number of companies do, because a dash cam can instantly prove fault in an accident, saving them a fortune in investigation and legal fees. They're willing to pass a small part of that savings on to you. Also, if your teen's driving habits change, for example, they go off to college and leave the car at home, look into pay-per-mile insurance. For low-mileage drivers, this can slash costs by 50% or more, because you're only paying for the insurance you're actually using. Leveraging technology isn't a one-time setup. It's an ongoing conversation with your insurer, using data to prove you deserve a better rate. The final component is the milestone method. Your teen's insurance rate is a snapshot in time based on their risk profile. But life isn't a snapshot, it's a movie. And as major life milestones occur, that risk profile changes dramatically. Your job is to make sure the insurance company updates the price to reflect the new lower risk. The first huge milestone is age. While rates gradually decrease each year, the big drops often happen at specific birthdays, most notably age 25. But here's the secret. This discount is almost never applied automatically mid-policy. The system will only re-rate you at renewal, and even then it might not give you the full benefit. You need to be proactive. A month before that 25th birthday, call your insurer and say, "My child on my policy is turning 25 next month. I'd like to get a quote for what our new premium will be once they are re-rated as a 25-year-old driver." This forces them to run the numbers and lock in that significant price drop the moment it's available. Another milestone is academic achievement. We mentioned the good student discount, but it doesn't stop at graduation. Did your teen graduate from a 4-year university? Call your insurer. Many offer an alumni discount or a degreed professional discount. It's another way of telling the actuaries that this person is responsible and a lower risk. Next, credit score. When your teen first starts driving, they likely have little to no credit history. But as they get their first credit card, pay their bills on time, and build a positive credit file, their insurance risk profile improves significantly. In most states, a higher credit score leads to a lower premium. Once your teen has established a good score, typically over 700, it's time to call the insurer and ask for a re-rating based on their improved credit. This alone can account for a 10 to 20% drop. And think about the future. When they eventually move out and get their own place, that's a milestone. Bundling renter's insurance with their auto policy will unlock a multi-policy discount. When they get married, that's a huge milestone. Married individuals are statistically safer drivers, and premiums for married couples are almost always lower. You have to inform the insurer of this change to get the benefit. Each of these milestones is a trigger. It's a reason to pick up the phone and challenge your rate. Putting it all together, the annual audit, the technology leverage, and the milestone method, creates a perpetual cycle of savings. You are no longer just a passenger on this expensive ride. You are in the driver's seat. You've gone from the shock of that first 4-figure quote to a place of complete control. You know which car to buy, how to structure the policy, every discount to ask for, and you have a bulletproof long-term system to keep those rates plummeting year after year. The single biggest mistake anyone makes with insurance is to set it and forget it. But now you know better. You have the playbook. The journey of 1,000 miles begins with a single step, and your journey to affordable insurance begins with a single phone call. Make that call.